War in the Middle East, political dysfunction at home, crazy valuations on an unproven technology, gas headed towards $5 a gallon, and yet the stock market refuses to crash. What are the factors that are keeping this upward momentum going? And why, despite all of these obvious risks, does the market remain optimistic? Well, I think there's a number of reasons behind this. Some of them are well known. I think some of them are not as well known. But let's talk about some of these factors because I think there's a lot of people out there, well, I know there are, who for years have said this cannot go on. And yet it does. And so I think the more we can understand what the factors are at play that can keep this going on longer than any of us think possible, will give us a leg up in understanding if and when there is going to be a pullback or if and when there is going to be a crash. And so I'd come up with a bunch of different reasons that kind of help explain it. And I think some of these, a lot of you may already be familiar with. But the biggest one, I think, is the rise of passive management. And you guys have heard me talk about this before. I'm sure many of you are familiar with my friend Mike Green, who kind of came up with this, his reasoning for this eternal bid for equities and the rise of passive management. If you guys are not already familiar with Mike Green, well, then stop listening to me and go listen to him because he's brilliant. And he first started talking about this, I don't know, maybe 10 years ago. And his work, luckily, I have very smart friends like Mike, and his work ended up influencing my overall thesis tremendously. And essentially, the thesis is that we get this rise of passive management as opposed to active management, there is this ever increasing and steady bid for risk assets and specifically US equities. And this is because the passive machine does not think. It buys whenever it gets money and it sells every time somebody asks for money. It doesn't ask for the price. It doesn't ask for the reason. It doesn't complain and it doesn't debate. It just does it. It's the simplest algorithm in history. If I get cash, I buy. And if I'm asked for cash, I sell. So it's price insensitive by design. And in fact, higher prices can actually push prices higher higher still. So it becomes kind of this recursive thing. And it's not just that this exists, but this is becoming an increasingly large percent of overall equity funds. 20 years ago, this was less than 20% of funds were passively managed. These are like index funds. And close to 80% were in active management. Well, as of about 5-6 years ago, that flipped. The passive became a bigger share, and now passive is over 50%, and active is down to like 40%. So it's a pretty incredible change, and I think this is a big explanation of why the market it doesn't always go up, but it's part of the reason why we don't have these crashes. And when we do have the crashes, it's why they have recovered fairly quickly. And so I would encourage you, if you're not already familiar with this rise of passive, to go check it out because this never-ending bid for equities is largely a result of this passive machine. Some of the other things, well, the reason that this is so prevalent is not just that they exist, but again, the automatic bid is a lot of these index funds are in things like IRAs, 401ks, pension plans. And so every time somebody gets paid, whether it's every 2 weeks, once a month, once a week, a slice of every paycheck gets swept into the market. And it's on autopilot. Like I said, every time they get cash, they buy. Again, it doesn't matter what prices are doing. And so, 12% of somebody's pay oftentimes goes into the market. And there's $70 million or 70 million people that have active 401ks or IRAs or some kind of a retirement plan. And 84% of those assets then go into index funds, which are target day funds, which basically just buy the market. And so, if you've got retirement assets of $50 trillion. And so again, it's just this steady thing. And as long as employment holds up, this steady bid is going to be there. Some of the other reasons is it's not just US investors doing this, it's foreigners. And this is something I've been talking about this for years, that foreign flows find their way into the United States. Now, some of it comes into bonds, some of it comes into real estate, a lot of it ends up in US stocks. But there's 35 trillion of foreign owned stocks and bonds in the United States. And the net international investment position has been going one way for 20 years now, and it's up to $27.5 trillion. A lot of that money finds its way into the stock market. And again, when that money shows up, there's no question of whether we're going to buy or not. There's no question of what the management team is up to. There's no question of what the balance sheet says. There's no question of whether the price is appropriate. It's just, is there cash? And if so, buy. And so, $20 trillion of US equities are held by foreigners. Another 9 trillion is held by in treasuries, and then, another 6 trillion in agencies and other corporate debt. So, there's a steady flow, bid from retirement local assets. There's a steady bid of foreign flows that contribute to it as well. The other way is that this is relatively new. Now, this is also coming from foreigners, but this is a different channel, and this is a result of tokenization, and this is a result of U.S. dollar stablecoins. You guys have heard me talk about it, saying that I think U.S. dollar stablecoins are going to be as transformative to the global monetary system as when the United States left the gold standard. And part of the reason is, for a very, very, very long time, the wealthy, the elite, the leadership, however you want to define the upper echelon of foreign societies, always invested in the United States. But to do that, you had to have a brokerage account or some kind of an international bank account, and you often had to have at a minimum $10,000 to access dollars and then access US assets. But tokenization of assets and US dollar stablecoins has allowed that to drop substantially. And now it's essentially, the US stock market is now open to essentially anyone with a phone, right? And tokenization, the buying of tokenized US assets, 84% of it's coming from emerging markets. Only a small percent is coming from developed markets, because these developed markets already have ways to access US assets. But in emerging markets, they have fewer ways, and they don't typically have the same purchasing power as some of the more developed assets or developed countries. But this tokenization has dropped the ability to get into the US stock market to $5. And so this is a whole new ocean of people that now have access to buying US assets. And if you can buy US assets, why are you going to buy South African assets or Thai assets or Sri Lankan assets or Turkish assets? So it becomes kind of this funnel that flows even more liquidity back into the US and US assets. And I think that this tokenization of assets and rise of US dollar stablecoins is just getting started. So that's another reason why money flows into the US. It hits that passive management mandate, and it's just buy. And so again, as long as those hold up, I think that's a reason why the stock market is holding up. The other reason is that, for better or not, and even though the United States has all kind of problems, and we could come on here every week and talk only about the United States problems. There are many, many, many of them. But as you've also heard me say many times, the rest of the world has problems as well. And, right now, Europe has a war in Ukraine and an energy shock, right? And so $300 billion leaves Europe almost every year and comes to the United States. And so this is part of the reason why assets come from the rest of the world into the United States. China has capital controls, and they have a property bust, right? And so $1 trillion left China last year. Now, a lot of that went to Hong Kong, but some of it came to the United States. And so, and again, when it hits the United States, it just buys. And then we've got a war in the Middle East, right? And not just war. I mean, we've had war after war after war, but $2 trillion of investments have been pledged from the Gulf states to the United States. So that's another reason why this can go on a lot longer than people think. And so when a region destabilizes, the capital runs for the exit. And it doesn't always come to the United States, but more often than not, it comes to the United States. Now, there's another reason, and it's kind of gravity, really. Part of the reason that it comes to the United States is money has already come to the United States, and if money has already come there, there's more liquidity there, and if there's more liquidity, there's typically less risk, and so it kind of makes it. The other thing is when people allocate, you don't get fired for allocating to the United States. In other words, if you have to choose between allocating to Mexico and allocating to the United States, and you choose Mexico and Mexico blows up, you get fired. But if you allocate to the United States and something goes wrong, well, everybody else, everybody else allocates to the United States. So, it's just an unfortunate event. You didn't make a wild decision. And so therefore there's some job security there. So that leads to people overseas making the decision to allocate to the United States. Again, part of the other reason is FX reserves, 57% are in the US dollar. Now, I know a lot of people are going to say, well, gold has been rising and gold is a bigger percent now. Okay, fair enough. But when these people are allocating assets, they are offsetting liabilities. And because the dollar is used as the liability for the whole world, in order to not have a mismatch between assets and liabilities, they will typically try to buy US dollar assets. And so again, this is just, it's kind of a network thing because the United States dollar is the biggest network in the world. United States assets is the biggest market associated with global assets. And it just becomes easier, quicker, more liquid, et cetera, to allocate to the United States. And then, as I said, it hits the United States, that passive bid shows up and boom, asset prices remain elevated. Now, the other one is, I don't think people are aware of this. Some people are, but I don't think this is a commonly understood thing, is that the United States is the biggest offshore tax haven for all the countries in the world other than the United States. Often U.S. investors think of a tax haven as being the Cayman Islands, the Cook Islands, maybe Dubai or Monte Carlo or somewhere like that. But for people who are not U.S. citizens, the biggest tax haven in the world is the United States. And it's not even close. 25% of the world's offshore financial services run through the United States, by far the largest share of any country. $700 billion is parked in South Dakota, these tax-free trusts, and it's growing about $100 billion a year. And most tax, and the United States doesn't tax foreign capital. So most of the capital coming in is taxed at 0%. Even those countries, local authorities often don't tax on foreign assets. And so that's another reason why assets come to the United States. But there's a bigger reason, and that is that it's a one-way mirror. Since 2010, and I actually, this ended up affecting me when we used to store gold in Switzerland. We ended up getting kicked out because they didn't want to deal with Americans, because in doing so, they had to report back to the IRS. And so since 2010, more than 110 countries have had to report Americans' accounts back to the IRS. And the U.S. didn't join the same thing. That means that it reports back to those countries. In other words, the United States demands that foreign tax authorities and foreign financial authorities report back to the United States if any Americans have accounts there. But the United States does not turn around and reciprocate that same thing back to those tax authorities. And so there's 126 jurisdictions that have to file and report back to the United States. But the United States does not turn around and report. Remember, I was talking about $35 trillion is held in U.S. assets by foreigners. The United States does not turn around and report that back to those tax authorities and those financial authorities. So it's a huge, huge, huge mismatch. And that makes the United States extremely attractive for foreigners who own large amounts of capital and want to get it in a taxable or a non-taxable jurisdiction. So that leads to more capital coming to the United States. And again, at the end of the day, it's just, the United States has the biggest market. And again, that leads to bigger liquidity, less risk, et cetera, et cetera. And so as capital concentrates, it almost becomes like a black hole. The more assets that are there, the more assets it attracts. The United States stock market is 4 times bigger than all of Europe combined. Again, it's a knock-on effect of the fact that the United States has the global reserve currency, and it's the biggest network, and it has the largest markets, and it just makes it easier, and and it makes it more attractive place to allocate capital. And then, the United States has this huge current account deficit. That just shows that the United States is pulling capital in, and it's coming from China. It's coming from Germany. It's coming from Japan. It's coming from Switzerland. It's coming from the whole world. And that is the end of the day, is the milkshake. That is the United States sucking in capital for all of these various reasons from around the world. Think about that. Over $1 trillion a year gets pulled into the United States on net. And the ones that are running the surpluses, China, Germany, Japan, all these countries that we ended, that's where the money's coming from. And that ends up hitting that passive bid, and that ends up elevating asset prices. So until there's a big reason to leave the United States and start allocating to the rest of the world, that's why this persistent bid remains. And it's why, even if we have a sell-off, it will probably not last long and will likely rebound fairly quickly. But this is not to say, and I want to be clear, this is not to say that asset prices can't fall. It's not to say that the market can't go down. In fact, I think we're probably going to get a sell-off this fall. I don't know for sure. This is not a prediction. I'm not saying we're going into the Great Depression. I'm just saying there are the same things that can help the United States attract assets and push assets higher can also work in reverse. Again, on the way up, passive buys every name in proportions to its size. It's just kind of this steady thing. There's not a whole lot of thinking going on. But on the way down, the same thing happens. Once there starts to be a net ask rather than a net buy, and other people start asking for assets or asking for dollars or asking for cash rather than placing cash, then that same arithmetic runs in reverse. When contributions stop feeding the passive bid, and there's no one to step in to buy, and then when a selling can beget selling. And this is also why, if you look back at 2025 with the tariffs, if you look back at 2022 when they raised interest rates, if you look back at 2020 when we had COVID, it's why once the sell-off starts to happen, it can accelerate extremely quickly. So rather than having a 6-month day-by-day slow drawdown, you end up having a 6-day or a 6-week very fast drawdown, because passive works on the way down the same way it works on the way up. So it's not to say that this is a foolproof plan that can't cause a downside. The other thing is, as long as jobs hold up, there is this steady bid, because you get these IRA contributions, 401 contributions. But if you get a slowdown in unemployment, or if non-farm payrolls fall, such as spring of 2020, now all of a sudden, not only is there no bid, but because people are out of work, they're starting to tap their retirement savings because they have to live. And then you get the same thing on the downside, and that ends up with the passive management. It can go down very quickly. And so, every contribution rides on a paycheck. And once those contributions are gone, there is no bid. And so rising payroll feeds the automatic bid, but a falling payroll pulls it away. And going back to 2020 as an example, 22 million jobs were lost in a few weeks, which is, it's just insane, right? And that's why the whole world virtually shut down. And so that, if we get into a period of time where, unemployment starts to suffer, or unemployment starts to rise, that's when you can get a pullback as well. And then we talked about this in our recent report called The Band, which explains the dollar and how the dollar has to stay within the band for the market to function, or for the global system to function. we talked about this dual carry trade. So if you're not familiar with this, I would encourage you to go to our website and look up that paper and read that. But the global carry trade runs on dollars, but their local carry trade runs in their local currency. And so when you get a mismatch and when you get one rising faster than the other, and when you get the market slowing down, then a lot of times the local carry will have to get paid off before the global carry. And since currencies trade relative to each other, one of these carry trades is always going against the rest of the world. And if the local carry trade starts to go against them quickly, they will have to sell their US dollar assets because that's where they have their excess savings and repatriate them back to their home currencies and their home markets. And that can lead to assets leaving the United States. That happened in 2020. That happened in 2008. It happened in 2025. But then it typically reverses. But in that short periods of time, that can lead to the market coming down as well. Now, again, we highlight this in our report, the band, but this happened. You can see here, this is the dollar index, but when the dollar index is falling, initially, that's because the dual carry trade is going against the dollar and in favor of foreign currency. And then the dollar typically rebounds after that. But in that period of time, in 2008, the US stock market fell 37%. Now, the same thing happened in 2020. Again, you can see the dollar went down in February and early March, and then it spiked, and the stock market fell 34%. So, again, as the dollar is rising, the stock market is falling, and because the rest of the world is repatriating that capital because they're having to deal with their local carry trade. So anyway, that's another reason. But now we're going to look at a couple charts here because we've been talking about how markets, how they just haven't fallen. They have also stopped going up, though. They have gone sideways for 2 or 3 months now. They're up a little bit for the year. I think they're up. I think the Dow's up 8%, the S&Ps are up around 10, and the Nasdaq's up around 15 for the year. But a lot of that has got plateaued and has kind of gone sideways for a month or two. Now, it's interesting here because now the S&P is still pretty high above the 100-day and the 200-day moving average, but it has now broken below the 50-day moving average. So that's something to keep an eye on. But if you look at the stochastics, which are at the bottom, what's interesting here is the stochastics are at 14, which is already pretty oversold. I mean, this is why it wouldn't surprise me at all to see the S&P come down and test the 100 and 200-day moving average. And in fact, I think that's probably likely over the next few weeks or the next few months. But part of the reason I don't see a huge sell-off coming, and again, you have to be ready for it, but it's not my predictions because in many ways, it's already, the momentum is gone. And the stochastics are showing that, that 14, I kind of have this little kind of mini rule. If you get below 10, you kind of need to buy. So it's, I think that there's a mismatch there and then same with NASDAQ. I think the NASDAQ, the NASDAQ has come off a little bit more. It's below the 50-day. It's still above the 100 and 200-day. But again, you look at the stochastics are like at 10 and the RSI is like at, 39. So it's, the momentum is to the downside at this point but sideways. But I think we probably do test some of these moving averages, but a lot of times I think when momentum is super high, that's when you have the opportunity for a huge sell-off because there's a long way for it to fall. There's not a really, really long way for momentum to fall from here. And listen, it doesn't mean it can't happen. I'm just saying a lot of it the momentum has already come off. Kind of the same with the Russell. Now this one's a little different. This is the Bovespa. This is Brazil. So, they had a huge run up at the beginning of the year. It sold off pretty hard over the last 3 months. It's went through the 150-day moving average. It is now sitting just right at the 200-day moving average. But momentum is higher. So if we were to break that 200-day moving average, I could see the Bovespa come down very hard, very fast, because momentum is not wiped out here. And so it has a long way to fall on both the RSI and the stochastic. So those are just some things that I kind of look at to help me gauge how far and how fast things could go if they go that way. Now, copper, I think, is really interesting. And here's why. Copper is right now sitting at the 50-day moving average. And the stochastics are not super high. They're kind of in the middle of nowhere, kind of right around 50. But the RSI is right around the mid 30s or 50s. I'm sorry, but the stochastics are still pretty high. They're around 80, but they've started to roll over. And so the reason I think that's important is because if you look at the positioning, this shows positioning in copper, where black line is the price and the pink line is the commercial short position. Now, typically throughout history, whenever it gets, and the commercial shorts are at as big as they have ever been. So that means the banks are betting for the price of copper to come down. And so when you get an extreme price and you get an extreme short position, oftentimes, if you look back through history, just look at this chart here, you can see it, those revert. And so it wouldn't shock me at all, especially since we're sitting at an interesting place, right at the 50-day moving average. I think we could easily come down and touch the 100-day and probably come down and touch the 200-day as well. Now, I know some people are saying, what the hell? Are you going to short copper? And here's what I would say. I don't know if I'm going to short copper, but to me, shorting copper is an interesting tactical play, a short-term tactical play with a small percent of your portfolio. Now, if you're talking medium to long-term and fundamental, there's a huge fundamental reason over the medium to long-term to buy copper. And I think it's going to go much, much higher in the years ahead. But right now, it's sitting at an interesting level. And if I was so inclined to take a little bit of a higher risk, higher reward trade with a small percent of the portfolio, I think this is an interesting thing to look at for the reasons I just talked about. And other people I know are saying, but Brent, we're right on, we've got all of this supply chain stuff going on. We've got a trade war with China. We've got a real war with Iran. That is bullish for real assets. Again, I totally agree with you. But if you go back and you look at our show in December on the debasement trade, and then our show a couple of weeks ago on the debasement trade, we made it very clear that while we believe in it medium to long term, there will be short periods of time where it will go against you, and it will go against you hard. And so you have to understand that markets don't move in a straight line. And so from a short-term tactical perspective, I think this is an interesting trade. I do not have it on right now, but I'm thinking about it. So anyway, that's just something to think about. Gold is kind of in no man's land right now. Both the stochastics and the RSI are in the middle of nowhere. I think we've got the Fed meeting come up this week. I think Warsh is going to be hawkish. I don't think he's going to raise, but I think he's going to be hawkish. But I will say this, it would not surprise me if he raises. Again, that's not my call. I'm not saying that he's going to do it, but I will not be surprised at all if he does. I think more likely is he will hold and just talk hawkish. But the point is if for some crazy reason, but also I don't think he should raise rates. But it doesn't matter what I think. It only matters what he's going to actually do. If he for some reason raises rates, that would probably be bad for gold and silver. And I think that would probably set up an interesting buying opportunity sometime in August. So we'll have to keep an eye on that. But this is, what gold has done this year. It obviously had the big run up, and now it's kind of come back down to where it was last October. This is a reason why I think, I've said this many times. You guys know I'm on the board of Monetary Metals. I think this is why Monetary Metals is good for an allocation of your gold. Now, again, you don't do this with your doomsday stack. You don't do this with your whole portfolio. You don't do this with your gold that you have set aside for a rainy day. But if you're looking for another way to own gold and have it be productive, especially when the price of gold is either going down or sideways and not going up like it did last year, this is a way to hold on to it for that long-term price appreciation, but have it be productive in the short term. You can earn a yield on gold. Currently, it's around 4%, which is about the same as a T-bill, but you're not holding fiat, you're holding gold. So you've got your long-term stack, you've got your long-term price appreciation, but you're using it as a productive use. And for all the people that tell me that gold is money, if gold is money, then you should really like this idea, because monetary metals is using gold as money in the real world in a productive way. So if you think gold can be a productive asset and can help the world from a monetary perspective, put your money where your mouth is. Go to monetary-metals.com/Santiago and check it out, and perhaps even open an account. Now, I would be remiss if I didn't touch on the dollar index here. If we look at the dollar index, everybody knows that I'm a long-term dollar bull. But as I've said many times, markets don't go in a straight line. The interesting thing right here that we have is there is no resistance from a technical perspective above gold right now. So if they do raise rates or if they do talk hawkish, you could easily see the dollar go higher. But having said that, you look at the stochastics on the dollar, it's around 95. That's pretty high. The RSI is only 60, so it's not that high. But my point is if we do get a further run here in the dollar, that's going to set up a pullback in the dollar. And it wouldn't be surprised to me at all if we get a run in the dollar here into early August and then it rolls over for a month or two. If the dollar does not roll over from here, heaven help the world, because it could get ugly very, very quick. In any case, that's it for this week. If you like what we talk about, go to santiagocapital.com. Or if you want to read reports about some of the stuff that we talked to, go to research.santiagocapital.com. Also hit the like and subscribe button here. I'm told that helps us out tremendously. So anyway, hope you guys all have a great week. We'll be back again next week.